This is Sacha Pradyuman of Cirrus Research. The latest Outlook report is just out. It summarizes our key thoughts and takeaways for 2025. The dispatch title, Risk on Posture, to collide with valuations as Fed breaks promise on rates in 25. Let's jump into it. A couple of things that are truly supportive of risk assets as we look out for the years, and equities, of course. Number one, credit markets are incredibly easy. If you look at the last year, how credit spreads have rallied. In fact, what's more important is that while the US is at 30-year lows, the rest of the planet has also converged to these levels. Importantly, when we look at banks, also a proxy for credit markets, we see a pretty favorable backdrop. Loan growth data is stabilizing, and the purple curve, which represents earnings estimates, they're on the rise. We're looking at for every 10 estimates, we're seeing 7 out of those 10 estimates being increased for the year ahead forecast. If you go back just a year and a half ago, those were at a paltry like 1 in 10 estimate being revised. Clearly a better fundamental outlook. What if we do end up having a much more favorable regulatory backdrop? Importantly, risk appetites are also benign. So in other words, as much as this market feels frothy, it seems to us that this market has quite a ways to go in terms of bidding up firms. This year, we've seen a very narrow sort of run with the technology AI trade. The rest of the system has yet to truly participate. We've had some bouts of that in the last quarter or two. That is what we think may occur as we go forward here. At the heart of this, our asset allocation model has been locked in a favorable equity stance the last couple of years. It's been dead on. Even with the run-up, this number is a 66% equity allocation. Long-term equity allocation, that's a 30-year test we've run. It's roughly about a 49%. So this spread is still favorable. Importantly, why markets could get a lot more frothy. Bitcoin, for instance, could potentially act like a meme stock here. What if the news headlines on regulatory backdrop in the next year remains favorable, which is quite likely. So in other words, we see plenty of reason to look at this sort of speculative run. Importantly, though, underneath the system, we have a couple of things to look out for. Number one, interest rate risk. We think that the Fed will likely back away from its promise of 4 cuts for the obvious reason. The economic data remains strong, you've got terribly easy credit, 50-year lows on unemployment rates. At this juncture, for them to continue to cut rates becomes very questionable. We've seen how the bond market has begun to act. If that's the case, it is definitely more of a valuation-friendly market. Importantly, NVIDIA's top-line growth is beginning to slow. So this broadening that we've called for, I think, is more likely to happen as now you've got 2 to 3 quarters worth of evidence of a slowdown in NVIDIA's top-line growth. The beneficiaries are downstream. So again, this continues to favor our market broadening thesis, our more valuation sensitive thesis. Alternate AI downstream names, data center, nuclear, etc. These are groups that are likely to benefit in this AI expansion. Importantly, we can now formally say that industrials are in a super cycle. They've been outperforming for several years. The exception has been in the large cap arena with the sort of AI trade. Those absolute numbers, though, have been very, very strong. Take a look at the full report, and please join us. We'll be hosting our quarterly conference call. That email will go out shortly as well. All the best. Thank you.